everybody. Welcome to the Monthly Market Insight, the first Monday of August. We'll be kind of reflecting on everything this year through July and kind of going into the remainder of the year. So Sean, talk to us a little about kind of where we are in the markets, kind of the performance, as well as kind of make sense of which has really been the talk of this year is, where are we at with inflation? Where are we at with interest rates? Last week, some important data came out on the jobs report showing some the unemployment levels, the number of job increases as well as salary raises. So a lot of information kind of coming out. Sean, what does this mean to all of us and has it impacted the markets?
Yeah, so really the story of 2023 has remained consistent throughout the year. And that is, there's been a lot of fear in the market. And that's kind of what we're seeing right now on the screen is we've seen all this throughout the year, media coming out, next crash. We've kind of gotten away from kind of the recession talk, but that was going on for about 18 months. Recession, things are going to crash. And that's what we see in the media all the time is a lot of fear-driven things. But when we look at the actual performance of how the market's been doing, right, it reflects something completely different. So the NASDAQ for the year is up about 33.9%. The S&P is up about 17.1%. The Dow's up about 5%. And obviously you can see some of the other things that are on the screen. But one thing that we want to point out is our last market high was December 31st of 2021. 2022 was a story of high inflation. It peaked at 9.1% in June of 2022. It's steadily been coming down. Got last month's number of 3%. So really a huge drop in inflation from 9.1% down to 3%. We get our next inflation number on the 10th of August, right? So this Thursday, we're gonna get our next inflation number to see if that trend continues to come down from 3% to even farther below that. The Federal Reserve's target now is 2%. So they're still above that, but they're in a much more manageable situation. And one of the things that's changed is the interest rate is now above inflation. That hasn't happened really since 2008, right? It was floating around 0.25% for a really long time. While inflation was at 2%, people thought maybe it'd never get above that 2% mark. Now interest rates are about 5.25%, inflation's at 3%. It gives the Federal Reserve another tool to kind of manipulate the economy when things get stressed. So if we do start to see the economy get stressed, and they'll reflect in a stressed economy and an unemployment number, then they have a tool to say, okay, we can lower interest rates to encourage more spending. But what we saw at the end of July was the Federal Reserve raise interest rates one more time. They said, don't anticipate them dropping here in 2023. They may even do another rate increase in 2023. So we got more information about at the end of July about what the Fed wants to do. And if they do start to see some pain, they have the ability to lower interest rates. So that's kind of a good thing, giving the Fed another tool to kind of help the economy along, which could mean that we never get into this recession. We always end up in this soft landing because the Fed times the interest rate drop at the right time. That, again, we don't know. But the thing that we really want to highlight in the story of 2023 has been tech, which kind of makes up our NASDAQ, our growth indices, has done extremely well. And we look at the NVIDIAs, the Facebooks, the Apples, the Googles, the Amazons of the world, their stocks are doing very, very well. Now, the Dow represents about 30 companies from different sectors, not just tech-based. And the S&P, right, is going to be mostly made up of non-tech companies. We see those aren't doing as well. So what the market has been showing us is that tech has really been pulling up the rest of the market throughout 2023. So a lot of those consumables, those industrial companies have been being pulled up by the tech. That's what the market's been doing so far. So does that trend continue in 2023, or now does tech kind of cool off because we've got a lot of this chat GPT, this artificial intelligence spurring a lot of excitement in the tech industry? Does some of that cool off, and do we have some of the kind of normal cyclical companies starting to pursue and continue to grow here in 2023 towards the back half? That will be what we're monitoring. But 2023 so far, interest rates have come down. Interest rates have gone up. Inflation has come down. Tech has pulled up kind of the rest of the market. How do things kind of transpire moving forward? Do we continue to get lower and lower unemployment? Do we continue to get lower and lower interest rates and inflation data? Will that continue to make the market go? That's really what we've been monitoring throughout 2023 and what's been happening. Some of the data that came out, right, is this is the consumer price index, right? The inflation number for June, it was at 3%. That was a huge drop. You can see energy fell by a lot, right? And this is kind of month to month. So energy has been coming down. We've seen a lot of the commodity prices come down, right? Real estate has been struggling a little bit in the overall market, yet we don't see that. We've had a couple of clients buy and sell houses, and they're still paying over market. They're still getting asked over asking price, and people are buying houses at the 6 to 7% interest rate right now. So it's been a very, very unique market. This is more kind of the commercial real estate that we're seeing come down. So a lot of different things happening in the market that are driving down inflation. Again, we'll get the next report this Thursday, August 10th. And then the unemployment situation, this is what's been kind of the Fed's driving data point about whether or not they're going to raise and lower interest rates. So what we see, and this report just came out on August 4th, last Friday, we saw unemployment is actually at 3.5%. So it was at 3.7% the month before that. And really throughout the year, since March of 2022, it stayed between 3.4 and 3.7%. So we have not seen a lot of volatility in the unemployment market. What the Fed kind of considers a change or a recession would be a 0.5% increase from this 3.7% number over the previous 12 months. So if we get unemployment up to around the 4.2, 4.5%, those may be signs that the Federal Reserve will start to lower interest rates, but they've said they plan on keeping them high, maybe even doing another raise throughout 2023. That again is all data for the market to be able to go out there and make their predictions about how businesses are doing. We're starting to see some changes in the earnings reports. So as earning reports have come out, right, we've had some kind of really good earnings reports at the beginning of the year, starting to kind of get some mixed results here now. Do companies continue to have high earnings reports beating the analyst expectations, unemployment staying low, and inflation continuing to drop? That is going to be the story here for really the back half of 2023. And unfortunately, that's really what we've been saying this whole time, right? A lot of fear being pushed in the market, but the data continues to lead and show us kind of what's going to happen with the Fed and what's going to happen with the market. So those are kind of the big things so far here in 2023 and things that happened there in July.
All right, thanks, Sean. I don't have any questions that came in today. I know we're live on Facebook, so if there's questions, please put them in the comment or message Sean and I. And then we'll take a look at this Thursday. If you have questions on your portfolio as information comes out on Thursday, how that impacts you, just reach out to us. We're always open, happy to be a resource. With that, have a great August. I know schools are starting. I'm in Colorado. They started last week, so I don't even know where summer went. But I hope you all had a great summer, and we'll catch you back here in September.
Thanks, everyone.